one of the US's last big industrial conglomerates, is carving itself up. Honeywell International said it plans to separate its aerospace division from its automation business and move ahead with plans to spin off its advanced materials arm. Honeywell has been under added pressure to split from the activist investor Elliott Investment Management. Elliott pointed to the runaway success of General Electric since it completed a three-way split in 2024. GE's aerospace, energy, and healthcare units are now stand-alone businesses that, together, have a market value nearly 4 times bigger than GE had in 2022. The aerospace unit alone has a value of around $215 billion, which is more than double that of pre-breakup GE. Honeywell's share price had been underperforming the broader market, leaving the almost $150 billion conglomerate vulnerable when Elliott arrived. On Thursday, the stock initially rose on news of the breakup, but closed down 5.6% after executives forecast 2025 revenue and profit below Wall Street's expectations. Kapoor said he realized during the review process that the aerospace segment in particular was diverging more and more from other parts of Honeywell, given its rapid growth and bigger industry headwinds. We came to the conclusion that these 3 businesses are better separated to unleash what they have, said Kapoor, a longtime Honeywell executive who took over the CEO role in June 2023. Under his watch, Honeywell has already said it would spin off the advanced materials division and sell a personal protective equipment segment. Kapoor has sought to bulk up with smaller deals such as a $5 billion purchase of a security business and a $2 billion deal for an aerospace and defense technology company. Investors for years have pushed industrial conglomerates to break up or sell off unrelated businesses in an attempt to simplify and focus their operations and to make their value proposition clearer. Big conglomerates such as United Technologies, Danaher, and Alcoa enjoyed stronger performances and higher multiples after splitting. Others have faltered. A Bain study of 350 public spin-offs between 2000 and 2020 found that half of the companies failed to create shareholder value 2 years after their splits, and 1/4 saw their values erode. General Electric spent a decade unwinding disparate businesses, including a bank and appliance factories. Larry Culp, who became GE CEO in 2018 and now runs the spun-off aerospace business, paid down more than $100 billion in debt. The power business, GE Vernova, was a trouble spot at the time of its split, but has since ridden a wave of demand for energy as advances in artificial intelligence drive rapid growth in data centers. The separation of Honeywell's automation and aerospace businesses should be completed by the second half of 2026. Today, Honeywell gets about 40% of its annual revenue from the aerospace business, which makes engines and cockpit systems for Boeing and others. Underwhelming results recently in Honeywell's industrial and building automation units have dented earnings. An independent Honeywell aerospace business would be one of the largest aerospace suppliers, having booked $15 billion in revenue in 2024. The automation business notched $18 billion in revenue last year. The smaller advanced materials business did about $4 billion in revenue.